Welcome to Morphic Labs, and today we're going to be discussing advanced correlation for markets. More specifically, we're going to be talking about Chapter 8, co-integration and error correction mechanisms, or the error correction mechanism. But before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this. I would greatly appreciate your support. And if you're interested in increasing your market intelligence, which if you're into trading or markets in any capacity, you should be interested in increasing your market intelligence. That sounds like you. I have a free market microstructure and trading systems course that will walk you through the foundations of market structure, the mechanics of trading market data and analytics, everything from market structure and trading venues, order types and execution, to liquidity and market impact, everything that a serious market participant should know. Plus, if you're interested in looking at markets from different angles, I have a free advanced market aggregation course that will work you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow microstructure aggregation, event-driven and hybrid methods, plus implementation and selection criteria, so you can pick the most optimal aggregator for your specific use case. If you found it interesting, the links are in the description. Just sign up to be a free member, and you'll have both of these resources all to yourself for free. Now let's get into the technicals. Chapter 8, co-integration and the error correction mechanism. While correlation measures the degree of co-movement between stationary series, many financial time series are individually non-stationary, right? Meaning they have a integrated of order 1 or I of 1, yet share common stochastic trends. Reference 9 introduced the concept of co-integration to describe this long-run equilibrium relationship. If a n-dimensional vector y sub t is I of 1, but there exists a linear combination, the transpose of beta times y sub t that is I of 0 stationary, then y sub t is co-integrated with co-integrating vector beta. The error correction model, ECM for short, describes the short-run dynamics, which is described as delta of y sub t equals alpha times the transpose of beta times y sub t difference 1 plus the sum of gamma sub I, where gamma is the short-run coefficient matrix, times delta of y sub t difference I plus epsilon sub t, which is the noise, right, where I indexes from 1 up until p difference 1, where essentially alpha is the speed of adjustment matrix. The term alpha times the transpose of beta times y sub t difference 1 captures the error correction. Deviations from the long-run equilibrium feed back into the short-run changes, pulling the system back toward equilibrium. Reference 17 and 18 developed the maximum likelihood framework for testing and estimating co-integration in vector order aggressive systems. The Johansen trace test determines the co-integration rank R, number of linearly independent co-integrating relationships, while the estimated co-integrating vectors define the long-run equilibrium subspace. Reference 6 addressed bootstrap inference for co-integration rank, improving finite sample performance. Here's a pairs trading application. Statistical arbitrage strategies identify co-integrated pairs where the spread z sub t equals the transpose of beta times y sub t is mean reverting. When absolute value of z sub t is greater than k times sigma sub z, a position is open betting on convergence. The half-life of mean reversion tau sub 1/2 equals the natural log of 2 over the absolute value of alpha, determines the holding period and capital commitment. Typical equity pairs exhibit a tau 1/2 of 5 to 20 trading days. Now, here's a table for some data insights. As you can see, we have a trace test, which is a statistical test that essentially assumes the null hypothesis that there's essentially R less than or equal to 1 co-integration vectors that exist, right? And we have our alpha cappy, we have half-life in days, and we have the ADF on spread, which is also a statistical test, the augmented Digney-Fuller test, which essentially assumes the null hypothesis that the data that we're looking at, it has a unit root and is non-stationary, right? Meaning that it's not really suitable for a mean reverting strategy, right? But as you can see, our pair WTI and Brent crude have a trace test of 45.2, so we can reject the null hypothesis, right? And as you can see, we have a alpha cappy of negative 0.04, right? A half-life of 16.5, and an ADF on spread of negative 4.32, right? And as you can see, JLD and GDX have a trace test of 38.7, meaning you can reject the null hypothesis And essentially, you have an alpha cap of negative 0.05 and a half-life of 12.6 and an ADF on the spread of negative 3.98, meaning you can reject the null hypothesis. And as you can see, SPY and IVV have a trace test of 52.1, meaning you can reject the null hypothesis. And you have an alpha Kappa of negative 0.089, a half-life of 7.8, and an ADF on the spread of negative 5.67. EWA and EWC have a trace test of 29.4, and they have a alpha Kappa of negative 0.031, a half-life of 22.4 days, and an ADF on the spread of negative 3.45. Apple and Microsoft have a trace test of 18.3, an alpha Kappa of negative 0.019, half-life of 36.5 days, and an ADF on the spread of negative 2.87. Right? And note that essentially P is less than 0.01 and P is also less than 0.05, right, for these specific statistical tests, right? Now, what are the advantages of this type of correlation? Number one, captures long-run equilibrium relationships. Number two, foundation for statistical arbitrage. Number three, economically interpretable parameters. Number four, well-established asymptotic theory. Its limitations: number one, requires I of one processes, i.e., the processes have to be non-stationary. Fails for stationary series. Number two, sensitive to structural breaks in co-integrating vector. Number three, sample-specific relationships decay over time. And number four, transaction costs erode profitability. And that's about it for today. If you found that interesting, hit the subscribe button if you want to keep up more content like this. I would really appreciate your support. And if you're interested in increasing your market intelligence, which if you're into trading or markets in any capacity, you should be interested in increasing your market intelligence. If that sounds like you have a free market structure and trading system course to work through the foundations of market structure, the mechanics of trading, market data and analytics, everything from market structure and trading venues, order types and execution, liquidity and market impact, everything a serious market participant should know. Plus, if you're into looking at markets from different angles, there's a free advanced market aggregation course that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow microstructure aggregation, event-driven and hybrid methods, plus implementation and selection criteria, so you can pick the most optimal aggregator for your specific use case. If you found that interesting, the links are in the description. Just sign up to be a free member, and you have both of these resources all to yourself for free. And that's about it for today. Hit the subscribe button. Would really appreciate your support, and I'm out.